In the first video of this series, we talked about what debt is and who controls it, and we found out that it's the central bank that controls debt and, more importantly, that chooses the interest rates. In the second video, we discussed about two different types of debt. So let's elaborate in this third video on why our economy needs someone like the central bank that balances the weight of credit. And also, why do we have recessions? How many times have we heard our parents say that this year the interest on mortgages decreased? How many times have we heard people saying that the interests are too high? Or saying that the interests are going down? But why do the interest rates go up and down? Why does the central bank need to move the interest rates instead of just choosing a fixed one? Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing, or finance in general. And if you love the subject, please consider subscribing. In the first video, we understood that credit, and so debt, is one of the most important aspects of the modern economy. But why do we need credit? What is the reason why the central bank decides to give credit to the commercial banks that will then give credit to people? To understand it, we need to concentrate on why we use money. Money is used as a means of exchange. It doesn't matter which exchange. It can be a loaf of bread, it can be a pen, it can be an hour of cleaning or a small portion of a company or even a university course. In each one of these cases, money is utilized as a means of exchange, and with money we give a certain value to the things we exchange. This brings us to understand that if we buy something, someone else had to sell it to us. Therefore, if we spend money, someone else will earn them, and the earnings of that person is called salary. That increases the buying power of people who ask for it. By increasing the buying power, so by increasing the amount of things someone can buy, it will increase the expenditure of that person. And as said before, by increasing how much a person spends, we increase the salary of another person. Giving credit is therefore one of the ways that we have today to increase wealth. Of course, this cannot go endlessly, because if we increase the amount of credit too much, so the amount of money in the economy, the value of every single dollar will decrease. This is because if many people have something, in this case dollars, the value of that thing will decrease, because it's not as rare anymore, and so we will be able to buy less and less goods with the dollars we had yesterday, and so we will have to ask for more and more dollars. This process would become exponential and no longer manageable. For this reason, the central bank has to intervene and control the inflow of credit in the economy. Still, in the first video, we understood that this is done by changing the interest rates accordingly. If the central bank decides to have low interest rates, many people will start to ask for credit, therefore to have debts. This is a normal behavior for the human nature. When something is cheap, many people buy it. Think about discounts. This behavior will therefore increase the money in circulation, increasing consequentially the expenditure, the salaries, and finally, wealth. At some point though, the single dollars will start to decrease in value. This is called inflation, and when value of money decreases too rapidly, something has to be done to invert the direction. The central bank decides then to do the opposite. If before they decrease the interest rates to increase the inflow of money, now they will start to increase the interest rates to decrease the inflow of money. And as previously said, the human nature will think about the rest. And if something is more expensive, people will buy less of it. This way, people will request less credit, will have less debts, will spend less, and finally, earn less. This way we will have less money circulating in the economy, and the latter will increase in value. This is called deflation. During this period, also known as a recession, instead of asking for credit, people tend to pay off their debts, and so to decrease the total amount of credit. We can therefore think about inflation and deflation as two weights on a scale, and the latter constantly oscillates between periods of inflation, where the expenditure increases, and periods of deflation, where the expenditure decreases, and with the expenditure also the salaries. We can schematize this concept as a cycle, and in economics this is called the short-term debt cycle. Normally though, the period of deflation is shorter than the period of inflation, leading to credit increasing anyways, even though in some periods it will decrease. We will then get to a point where the amount of credit will be too high, and the growth will no longer be sustainable. In the next video, we will discuss exactly about this aspect, and we will understand what happens when the limit is reached, when there is too much credit, and when the change in interest rates will not be enough anymore. So, if you haven't done it already, I would highly suggest that you subscribe immediately to the channel so that you can always be up to date whenever I post new content. And if you enjoyed the video, please leave it a like. This is one of the few ways that I have to see if you like the videos and therefore keep posting. Nonetheless, I will see you in the next video.